Question number 2. I am looking at purchasing a house. How do I figure out the math options and tax implications? Okay, number 1, when you are looking at purchasing a house, make sure you are not purchasing a house just for the tax benefits. Do not do that. I have personally heard realtors tell people, if you purchase this house, it will help reduce your taxes. That is not always true. In fact, in many cases, it's more untrue than it is true. Basically, once the Tax Cuts and Jobs Act was enacted and the standard deductions were increased, I think for married, filing jointly couples right now, that number is like $27,000 or something like that. So that means when you purchase a house, and that if that house is going to, and we're speaking of a primary residence, not a rental property, a primary residence. When a realtor says, hey, this house is going to help you save money on taxes, what they mean is that the interest that you're paying, the property taxes that you're paying on that particular home is going to exceed your standard deduction. Well, if you're married filing jointly, that means you would have to be paying more than that $27,000 number per year in interest and property taxes. And in many cases, for quite a few Americans, they're not paying that much in interest and property taxes. This does not apply to people who are living in California, New York, Connecticut, states like that, okay? We're talking the rest of America. We're talking the rest of America outside of those core states. They're probably not paying, the average person is not paying that amount of money in interest and property taxes per year. So that means you're not going to be able to take advantage of that particular deduction. So that's the first thing that I want you to keep in mind. Do not purchase a primary residence simply for tax purposes, because unless you do that math and you can figure it out, it may not benefit you. Now, if you do purchase a home for primary tax for that purpose, and maybe you also are a heavy tither at church, maybe you do give that 10% at church, you're giving $10,000, $15,000 a year, that might tip you over. When you combine all of those items that's listed on the Schedule A of the itemized deductions, that might tip you over. But again, just in and of itself, it may not be very helpful for you to purchase a house specifically for tax purposes. Other things that you need to keep in mind, if you do decide to sell that home, as long as you have lived in that primary residence for a certain period of time, you'll have what's known as a capital gain exclusion. That exclusion allows you to not pay capital gains taxes on the first $250,000 in gains if you're single, $500,000 in gains if you are married filing jointly. Something else that you should also keep in mind that relates to taxes is that there is a state and local tax limitation. It's known as the SALT limitation with taxes related to primary residence or second homes. Now, what this means is that if your property taxes, i.e. your real estate taxes, exceed more than $10,000, you are capped at the $10,000 limit. So that means no matter how much you're paying in property taxes, you could be paying $20,000, $30,000 a year in property taxes, maybe even more depending on the size of the home. You will only get a deduction of $10,000 on your federal tax return. Might be a little bit different per state, but on your federal tax return, you're only looking at a deduction of about $10,000. So those are some things that you have to keep in mind when you're considering purchasing your primary residence. These rules do not apply to rental properties. They do not apply to investment properties. Only your primary residence or maybe even a second residence or a vacation home.